How to generate consistent income trading options. In this video, we will be discussing a simple blueprint to trading options that will allow you to generate consistent income in the options market. This video will begin with explaining the strategy. After I explain the strategy, I'm going to go back and I'm going to explain the definitions to different words that may or may not make sense in this particular strategy. So at the very beginning, if you're hearing things that don't make sense, keep watching the video. I'm going to explain those things, because as a beginning options trader, one of the most difficult things is learning these new jargon terms and understanding the definitions for them. Once you get a handle on these different terms and what these definitions are for these terms, things get relatively easy. What you'll also find throughout this video is there's a lot of overlapping and commonality with different definitions of terms. So I hope you're ready. I hope you're somewhat excited to get an idea of how you can start generating consistent income, trading options with a simple blueprint that's great for beginners. If that sounds good to you, I've got a little more. The little more that I have at the very end of this video, I'm going to give you a link to some free resources to help you get this ball rolling faster for yourself. And if that sounds good, then please consider subscribing. Now, let's get into this simple blueprint. It is called the wheel strategy. The wheel strategy is an easy, profitable approach to trading options. It basically consists of two main components, which we see here. So the wheel strategy begins with selling a cash secured put option. If your put option expires worthless, then you sell another cash secured put option. If your put option gets exercised and you acquire shares of the stock, then you begin selling covered call options. If your covered call option expires worthless, then you sell another covered call option. If your covered call option gets exercised, then you sell the stock and go back to selling cash secured put options. The wheel strategy. Before we go into defining the different terms, let's look at the pros and cons. You can start generating income from day one. If you structure the wheel strategy properly, it is difficult to lose money. The wheel strategy is a great long-term income source. You really don't need much time when you are properly structuring this. You can have a really busy lifestyle and still be generating income from this strategy. And one of my favorites, it highly increases financial intelligence. Now we looked at some pros. What about the cons? One con is there's limited profits. With the wheel strategy, you are limiting your profits in almost every segment of the wheel strategy. So a solution would be learn higher return on investment strategies also, if desired. When we look at one of the pros for it, that it highly increases your financial intelligence. Once you have the wheel strategy down where you're somewhat proficient at it, it's going to be much easier to learn these higher ROI strategies. Another con is it can tie up capital for a long time. So the solution is have the mindset that you might own the stock the rest of your life. And we do have a con of it requiring 100 share increments. So the solution is choose stocks you can afford 100 shares of. And just as a hint, at the end of this video, I'm going to help you figure out how to do that for yourself. But with 5 pros and 3 cons, the wheel strategy is a winner in many situations. Now let's get into defining wheel strategy terms. Up here in italics will be what I read to you before, and then we're going to go through and explain these kind of line by line. One thing that I really want you to be aware of is in the 2 aspects of the wheel strategy, the two parts, you're going to notice that there's a lot of the terminology is the same. So that should make the learning easier. Once you kind of understand it for one part, you can understand it for the second one when you realize there's a lot of overlap. It's just a little tweaking. So let's look at it. The wheel strategy begins with selling a cash secured put option. Right? What is a put option? A put option is a contract that gives the buyer the right to sell 100 shares of stock. Okay, so a put option is a contract that gives the put option buyer the right to sell stock. And this stock is being sold at a predetermined price called a strike price. And this is for a given amount of time. Now the put option buyer pays money to the put option seller called a premium. This money is paid for the put option seller's obligation in this. When the seller of the put option contract has the money to fulfill this obligation, it's called selling a cash secured put option. So you have the money to buy 100 shares of stock. You sell this obligation. Someone pays you for this obligation. You have a predetermined price. It's called a strike price. And the money you get paid is called a premium. And what is this obligation about? It's about you buying shares of stock from somebody at a certain price. And you're kind of just waiting there in a certain amount of time to see if it's going to happen. And you get paid money up front for that. If your put option expires worthless, then sell another cash secured put option. All right, what is expiring worthless? Well, as previously mentioned, a put option is valid for a specific amount of time, called the expiration date or days till expiration. Upon expiration date, it is possible that the seller does not need to fulfill the stock buying obligation. This is known as an option expiring worthless. So when you initially sell that cash secured put option for that specific amount of time called the expiration date, it's possible that during that time frame that you are not required to fulfill your obligation. You're sitting there waiting to see if you need to fill it. You might need to fulfill that obligation or not. If you do not need to fulfill that obligation, it's called the contract expiring worthless. But what if you do need to fulfill that obligation? If your put option gets exercised and you acquire shares of stock, what is exercised? As we learned, the put option seller, as a put option seller, you have the obligation to buy shares of stock under certain conditions. When you are called upon to fulfill your obligation, it is known as exercised or assignment. Then, what are you going to do? You're going to move to step 2 of the wheel strategy, right? You're going to begin selling covered call options. Well, what's a covered call option? A call option is a contract that gives the buyer the right to buy 100 shares of stock at a predetermined price called a strike price for a given amount of time. The buyer of the call option contract pays money to the seller of the call option contract called a premium for the call option seller's obligation in this. When the seller has the stock to fulfill the obligation, it is known as selling covered call options. So this is very similar to what we did with selling a cash secured put option. The only difference is instead of having cash secured, we have stock that is doing this for us. And another difference is that instead of selling an obligation to buy stock, we are selling an obligation to sell stock. With either one, we have our obligation covered. In this case, we have our obligation covered because we're selling an obligation to sell stock, and we have the stock to sell it. Because, why do we have the stock to sell it? Because of step one. We were selling call options. We were selling cash secured put options. We were selling the obligation that we would buy stock at a certain price, and we had the money to do it. Eventually, we bought that stock. And now that we have that stock, we're going to sell an obligation to sell the stock. And since we have the stock to do it, it is selling a covered call option, right? We'll keep going through. Hopefully it's starting to, oh yeah, kind of makes sense. There's a lot of similarity, hopefully, but let's keep looking. Now, if your covered call option expires worthless, sell another covered call option. As previously mentioned, a call option is valid for a specific amount of time, called the expiration date or days till expiration. Upon expiration, it is possible that the seller does not need to fulfill the stock selling obligation. This is known as an option expiring worthless. If your covered call option gets exercised, you sell the stock and go back to selling cash secured put options. As we learned, as a call option seller, you have the obligation to sell shares of stock under certain conditions. When you are called upon to fulfill your obligation, it is known as exercised or assignment. And then you're going to go back to selling cash secured put options. Thus, the wheel strategy. Step one, selling cash secured put options until assignment. So you have the money in your account to buy at least 100 shares of a particular stock. You sell an obligation into the market that says for a certain amount of time, I will buy X amount of these shares of the stock at this certain price. For that, you're going to get paid a premium. At the end of that contract time, the contract is either going to expire worthless and you keep the premium, or the contract needs to be fulfilled and you need to buy those shares of stock, but you still keep the premium. So now you have premium and stock. And it moves you into step number two, selling covered call options until assignment. So now we have stock. We sell a different type of obligation. An obligation that says we will sell this stock at a predetermined price. And we're going to take in premium to do that for a given amount of time. At the end of this given amount of time, the contract either expires worthless or we sell the stock. And of course, we're going to sell the stock for a higher price than we bought it. And we keep the premium. Then we go back to step number one. Thus, the wheel strategy. You can spin the wheel of fortune. Let's look at this through my Tastyworks account. And this is called the option curve view. So you might have heard of option chain. It's a way to look at various things of selling options and buying options. And this is just a different view that makes understanding this a little easier. So going across here, we have a continuum of this particular stock, the price. And it just happens to be an ETF called XLF, which is financial stocks ETF. So we see the stock price is currently right here, 33 and some change. And with this red thing, we see that is selling a cash secured put option at $31 for 21 days, right? So the strike price of 31, it's pointing right here, shows us 31, expiring in 22 days. So this would mean we would have to have $3,100 in our account in order for it to be a cash secured put option. Now, if the strike price is over $31 in 22 days, the option expires worthless. So at the end of 22 days, if the stock price is anywhere in this green area, it expires worthless. You keep the premium. If the stock price is below $31 at the end of 22 days, which is anywhere in this red area, you keep the premium and you buy the stock at $31. Now let's look at covered call options. So the stock price is currently here at $33 and some change on this stock price continuum. And we see with this red thing here, we're selling a covered call option at $35 for 22 days. Right? Strike price of $35 with the expiration of 22 days. If the stock price is below $35 in 22 days, which is anywhere in this green area, the call option expires worthless. You keep the premium and you keep the stock because you have at least 100 shares of the stock to sell. That's why it's a covered call option. If the stock price is above $35 in 22 days, anywhere in this green, you keep the premium and you sell the stock for $35. Option, contract, multiplier, or size. Understanding shares per option contract is vital to staying out of trading trouble. In the US stock market, one option contract is equal to 100 shares of stock. For a $25 stock, you would need $2,500 minimum in your brokerage account to sell one cash secured put option on that stock. You would need $5,000 to sell 2 cash secured put options, and so on. So whatever the stock price is, you multiply that by 100, and that's how much money you'll need to be able to fulfill your obligation if you are called upon. For call options, the same is true. If you sell one call option contract, you would need 100 shares of the stock to cover it. If you sell 2 call option contracts, you would need 200 shares of stock, right? Because one option contract equals 100 shares of the stock. Stock selection: price, time, and dividends. Because the option contract size, you must choose a stock that you can afford to purchase at least 100 shares of. Also, choose a stock that you would be okay owning the rest of your life if you had to. Consider also choosing a stock that gives dividends. Stick with me through the end of this video. At the end of this video, I am going to give you a free resource that you can use to help select stocks that are good for you to be selling cash secured put options on and doing the wheel strategy with. So what strike price? Now there's multiple right answers for strike prices. And of course, usually what everyone is concerned with is how much money am I going to make, or the return on investment. Well, some other things to consider besides return on investment. What's your current life situation? If you have $5,000 in your trading account and you have a newborn baby, is it possible that you might need that $5,000 for an emergency? Or do you have $100,000 in the bank for emergency and this $5,000 is just to learn? Whatever the situation is, right? If you might need to pull this money out, then consider selling a strike price that is further away from where the stock is currently trading, because if the further away the strike price is from where the stock is currently trading, then the less likely you will get exercised. Speaking of exercise, are you more or less interested in assignment? Because as I mentioned, the further away the strike price is from where the stock is currently trading, the less likely you are to be assigned. And are you comfortable buying or selling at this price? A lot of people get driven by how much money you can make in the premium. And you might start thinking, the stock's not gonna go there. Well, when you sell an option, there's always a chance that you're gonna need to fulfill that obligation. So ask yourself, hey, even if there's only a 1% chance that I'll need to fulfill this obligation, am I comfortable buying or selling at this price? And ultimately, there's a return on investment. And see that video for the option calculator to get a better idea with that. Now, what about expiration date? Now, choose an expiration date that fits your life. And think about this sort of the same way that we were just talking about the strike price. What's your current life situation? Are you getting ready to go on vacation for a month? If you're going to be gone for a month, then maybe you don't want to sell an option contract for 10 days. Maybe it's going to be too much of an inconvenience if you're gone for a month. So maybe you sell an option contract for 40 days. Again, are you more or less interested in assignment? With this option contract expiration date and looking at more or less interested in assignment, stocks are easier to predict where they will and will not go in a very short amount of time. So, for example, I can be much more accurate in determining where a stock will or won't go in the next 5 days than I can in the next month. So when you're thinking about expiration date, are you more or less interested in assignment? If you're less interested, maybe sell for a shorter time. If you're more interested, maybe sell for a longer time. If you are going to be leaving for a month and you need to sell for 40 days, then maybe you need to pick a stock that you're okay with buying. And that brings us to this one. Are you comfortable buying or selling at this price? Ultimately, that's really what it boils down to. Are you comfortable buying or selling at this price? Because a lot of the benefits of this strategy go out the window if you get to the situation where you're about to get exercised and you're scrambling to make that not happen. Then all of a sudden, it's not that fun. And the way I particularly like to use the wheel strategy and the way that I've seen other people very, very effortlessly and non-stressly implement it into their life is by doing it this way, where no matter what happens on expiration, you're totally okay. And ultimately consider the return on investment. Now here are some ways to get an idea of a stock price's movement, statistical measurements, right? So right here on this price continuum, we see that this right here gives a statistical indication. I think it's based on volatility and some other mathematical things of how much the stock is likely to move. And up here we see these first standard deviation and second standard deviation. So you could potentially use things like that to help determine which strike price to sell at. Another thing to keep in mind is the bid-ask spread. Now the ask is this higher number, right? And the bid is this lower number. So look at the bid-ask spread, and which is the difference between these two numbers. The wider the range between these two numbers, it could indicate a more difficult time getting filled. So for example, when we look here at this $33 strike price, we see 22 cents and 69 cents, which is much tighter of a spread than we see here at the $31 strike price, 2 cents and 29 cents. Using the wheel strategy the way that I have been describing it to you, where you don't care what happens at expiration, then that idea right there negates some of the other factors that having a wide bid-ask spread bring into play. So if you're watching this and you're thinking, yeah, well, what about slippage? Or I heard about slippage. It's 100% true. However, when you don't care what happens on assignment, it kind of doesn't matter. Now, what I like to do for determining what strike price I'm going to sell at, and sometimes for what time frame, is to use stock charts. We'll take a quick look at this stock chart. I'll explain some things to you, and on the next slide I'm going to tell you how I can help you a little more. So this is what's called a Japanese candlestick stock chart. At the bottom here, these red and green lines going up, these are volume, the volume of transactions. Right? So you can see right on this day was very low volume, and you see over here lots of selling volume. Right? When we look at going over here, wow, look at that, lots of buying volume. So this is volume down here. And this red line is a 200-day moving average. Now sometimes a 200-day moving average, it can be whatever color you want it to be. I particularly like to have it red. The 200-day moving average is an average of the stock's closing price over the last 200 days. A lot of institutions, a lot of traders will watch this and use it as a reference point. So whether or not there's some true like Mother Nature type of effect with it, it has some impact, if only for the reason that a lot of people will watch it. Now this bluish line here is the 50-day moving average. Obviously you could have it be whatever color you want, and just like the 200-day moving average, it's an average of the closing price over the last 50 days. Similar to the 200-day, a lot of people watch it, and it does tend to give you some indications of things. So these red and green things here, these are candlesticks. And depending on what these candlesticks are a daily candlestick. So one candlestick, whether it's this green one or this red one, shows 1 day of price movement. The different patterns can give you an indication of different things. And what I like to do for selling options is kind of look at it like this. Now let's pretend that we wanted to sell cash secured put options on XLF, one contract, and let's say that we have $3,500 in our account. So technically, to sell a cash secured put option, we could sell a strike price of $35 and still keep ourselves secure. But here's our chart here. Here's yesterday's trade, right? Now, depending on how likely we want to get assigned and a variety of other factors, here are some things that we could do. Now we see that around this time, so 1 day, we got 1, 2, 3, 4, 5. All right, kind of into last week, prices came close to this 200-day moving average. At this time, they hit it. But look at this. This is buyers coming in. Right, this is the body of the candle. It opened here and closed here. Prices came as far down here, but look at buyers push this up here. So what this is telling me is that the chance of it going below $30 is relatively low based on this information. Right, so I could potentially sell a cash secured put option with a strike price of $30. Maybe if I wanted to be a little more aggressive, maybe I could come up here to 32. If I wanted to be even more conservative, I could look to the left and look for, see how this is kind of some stagnation here, stagnant consolidation, whatever. I could see it over here too, right? See prices kind of went sideways here. It was down here, right? There's a bit of a line. Boom, when it got up over here, kind of went sideways, right around this $28 mark. So if I wanted to be even more conservative, I could look at that $28 mark. Does it mean there's going to be any premium there? You'd have to look and see. But that's just a quick way to look at the selling cash secured put options. Now, selling the covered call option, I'm going to do the same thing, but in reverse. Let's say our stock is currently trading here. Let's say we bought it at whatever, $32 or somewhere in there. I see prices kind of had made like a little bit of a line here. Look to the left. Oh, look at that little consolidation. Maybe I can consider selling at 36. If I wanted to be even more conservative, I could go up here to 38. This is a really quick way of looking at stock charts. If you want to have better help at selling stock charts, then consider subscribing to this YouTube channel, because I have a whole playlist here on a stock market weekly chart review, how to read stock charts for option trading, and it shows you a newbie hack to analyze the stock market. So this comes out every Sunday, usually around 10 in the morning, sometimes a little later. But so consider subscribing to this channel so you can get that, and over you'll be seeing the same sort of information, and you'll slowly start learning, or quickly learning, how to put these things together yourself. Now, I told you at the beginning of the video that I had some free stuff for you. So let's take a look at that free stuff. In the description of this video, there is a link to ihavesuccess.com. Depending on when you look at the website, could look something like this, could look a little bit different. But there, at the moment, there's 4 free downloads. The one that would probably be most powerful for the wheel strategy would be this download, Cash Secured Put Stock Selection Guide. This will give you guidelines of how to select stocks to sell cash secured put options on that you could use for the wheel strategy. You could also download 3 stocks that I sell cash secured put options on. These aren't the only 3, but these are 3 that I've been doing for years and continue to. I really like these stocks for a variety of reasons, and it will that download will explain that. You can also get the stock option Greeks cheat sheet. Now, this is the first time in this video that we've talked about stock option Greeks, because if you follow the wheel strategy the way that I'm explaining it to you, the Greeks really don't matter. And that's mainly because when you're following the wheel strategy in such a way that you don't care what happens at expiration, then the Greeks, they pretty much don't matter. However, the Greeks are there. And as you're increasing your financial intelligence, and if you start doing option strategies that will give you a higher return on investment, then you're going to need to understand the Greeks to make that successful for yourself. So get this stock option Greeks cheat sheet so you can have an easy reference for what these different Greeks names are and a 1-sentence definition to go with them, at least to get the ball rolling for you. And my favorite, 3 underused tactics to transform your financial results. These tactics are applicable to anything. They're not specifically just for the stock market. However, tactic number 3 is the hardest to implement, and financially will give you the biggest reward. It's not easy. However, it will be well worth the effort. And if you do this, there's going to be some intangible benefit that I can't really just explain, other than an amazing peace of mind that will come over your life and help you out with your trading, help take stress away. So put your information in there, download one, download all of them, whatever you want. Anytime I make something new, it'll be sent right to your inbox. Please like the video, subscribe to the channel so you can get more stuff in the future. There's going to be videos popping up and playlists popping up. Watch whatever one your intuition is telling you to go to. They're all applicable to what we're doing here. Most importantly, go get this cash secured put option selection guide and subscribe to the channel so you can be notified with the new stuff. You guys have a fantastic day. Aloha.